Hey guys, we'll hop right into it with the graph here from Morgan Stanley Research. It showed the estimated financing needs breakdown for capital expenditures from 2025 to 2028. I just thought it was an interesting graph to see, not only the $2.9 trillion anticipation and spending needs for data centers, excluding power. And you can see as you flow down here, this is the amount estimated to be covered by cash flow and so on to where we get down here to where we can see the 800 billion in credit opportunities and 350 billion in other capital. It's a pretty unique position and interesting just to take into consideration within the broader market context. Below is a table of recently reported tech software companies with their actual revenue here, then their consensus of their estimates, and then the actual difference here. So you can see across the board, all beat it top to bottom, every tech software company that's reported so far. Going forward and looking at next quarters, you can still see the trend coming through, albeit some are more ripped. The graph below shows July 2025 ETF flows by category, where big money is coming in of, out of, and blue and red. If you look down to the red, it's kind of interesting. You can see the movement out of defensive stocks, the long-term treasuries, and the small cap equities. And then, interestingly enough, there's big inflows been into crypto. One stock I think that can outperform the market is Uber. Track this company, I've been looking at total gross bookings. You can look at the picture to the left, both delivery and mobility bookings have shown steady volume growth. Even throughout Q1, the trend continues. Management's also guiding in their most recent earnings report for further top line growth, not from an increase in price, but rather from an actual increase in volume and new customers. They're launching in hundreds of new cities in 2025. Continued market expansion into less denser market has been management's focus point here. And even interesting graph to see is the free cash flow has continued to increase over time, which is exactly what you would want to see in a company. As you can see from the chart, free cash flow has been steadily increasing, while price to free cash flow has steadily been dropping. This is typically the disconnect you look for in an undervalued stock. Here's a new chart showing semiconductor companies with earnings per share growth estimates on the x-axis and forward price to earnings on the y-axis. Interesting to see Micron sticks out here, undervalued to all of its peers, despite impressive fundamentals, which we'll check out. Slightly different metric than what I was showing in Uber, but in the case of Micron, you can see their cash from operations steadily increasing here and trending upward, while their forward price to earnings is consistently trending downwards, which is another disconnect. So why Micron? There's going to be a big need for RAM, basically memory. It's going to be super important for running artificial intelligence programs, especially on devices like phones, computers, robots, not just big servers. Right now, most phone computers have 8 to 6 gigabytes of RAM, which is enough to run a small AI program, but it's slow. To run one really efficiently and smoothly, they would need way more RAM, like 128 gigabytes, which is why NVIDIA's new $3,000 high-end PC is. So just a quick couple bullet points here. Micron raised guidance to 11.1, 11.3 billion. We're currently trading at 3.1 times next 12 month sales, trading at 5.8 times EBITDA, and growing revenues at 46% and EBITDA just below 100%. Micron's, which you can see in the last slide of those big mega fab factories, is betting $200 billion that America can build the world's biggest chip fab. While some other big players like TSMC and INTC, the Taiwan Semiconductor Company, and Intel, nudge forward, Micron's memory-first strategy was driving outperformance, in my opinion. Shares have been up 93% from 52 weeks low, and it's only trading at a forward PE of 9.